CSCO spent the better part of a decade priced as a mature infrastructure vendor, reliable dividend, low growth, hold it for yield. That positioning drove capital into CSCO on the income side of the ledger, not the growth side, which meant the stock was systematically underweighted by funds running AI infrastructure mandates. On May 13th, that allocation logic broke. CSCO reported Q3 fiscal 2026 revenue of $15.84 billion, up 12% year over year, on earnings per share of $1.06 against a $1.03 consensus, numbers that, in isolation, look like a modest beat. What moved capital was not the beat itself, but the Q4 guidance, $1.16 to $1.18 in earnings per share, against a street estimate of $1.07, implying a revenue range of $16.7 to $16.9 billion versus expectations of $15.8 billion. A guidance raise of nearly $1 billion above consensus, in a quarter where the prior year's earnings per share was 96 cents, signals that the revenue acceleration is not a one-period event. The stock jumped 13.4% on volume 204% above its average session. That is not income investors rebalancing. That is growth mandate capital entering a position it previously had no reason to hold. HSBC's head of U.S. technology research, Stephen Bersey, made the reframing explicit. He raised his price-to-earnings target from 17.5 to 29, citing what he called Cisco's shift from a low-growth networking profile to a structural AI infrastructure thesis. That multiple re-rating is the capital flow event that matters, because it means the discount rate applied to CSCO's forward earnings changed, not just the earnings themselves. Morgan Stanley noted that CSCO is hitting a growth rate it has not achieved in more than 15 years, and growth rates that haven't been seen in 15 years do not fit inside an income stock valuation framework. The prior thesis, buy CSCO for the $1.68 annual dividend at a yield-supported floor, is not wrong in isolation, but it is now the subordinate thesis, not the primary one. Income holders who have not re-underwritten their position are now sitting on a growth stock priced for acceleration, which changes their exit calculus without them having changed their entry thesis. But the thesis flip alone does not explain why $9 billion in a single order category forced a sector-level reweighting decision.
The number that repositioned CSCO within the AI infrastructure sector is not the earnings beat. It is management's disclosure of approximately $9 billion in hyperscaler AI infrastructure orders for fiscal year 2026. That figure forces a comparison because NVIDIA, has been the default destination for AI infrastructure capital, and CSCO is now surfacing as a competing claim on the same hyperscaler spending budget. The distinction matters for positioning. NVIDIA captures compute spend at the chip level, while CSCO captures the networking layer that connects those chips at scale. And at AI training cluster densities, networking bottlenecks are not a secondary concern. When hyperscalers spend on AI clusters, the networking bill scales with the compute bill, which means CSCO's $9 billion order figure is a derivative of the same CapEx cycle driving NVIDIA's revenue, not a separate demand source. BNP Paribas analyst Carl Ackerman raised his price target to 132 from 87, a 52% revision, citing Silicon One networking chips and Acacia optics as the specific product vectors capturing that spend. The countersignal worth holding is that BNP's 132 target and HSBC's 137 both sit above the post-earnings consensus average of roughly 119, meaning the high-conviction bulls are meaningfully ahead of the central tendency. When analyst dispersion is wide and directionally one-sided above the current price, it typically signals that institutional positioning has not yet fully reflected the thesis shift, which is why volume at 204% of average is more informative than the price move alone. Morgan Stanley's expectation that AI revenues will quadruple year over year in fiscal 2026 introduces a compounding dynamic that income-oriented holders did not underwrite when they built their positions. The non-hyperscale product revenue growing 19% simultaneously signals that the AI networking upgrade cycle is not limited to the largest cloud operators. Enterprise and campus modernization is running in parallel. That parallel demand is what HSBC identified as the second and third growth driver: enterprise AI networking upgrades and campus modernization, as latency and security requirements rise with AI workload density. What that parallel demand structure means for sector weighting is that CSCO is no longer a substitute for legacy networking exposure. It is competing for allocation against pure-play AI infrastructure names on growth credentials alone. But the order book and revenue acceleration answer only half the capital allocation question, because Cisco announced a $1 billion restructuring on the same day it reported those orders, and those two signals point in opposite directions unless the cost reset is understood correctly.
The 4,000 job reduction,
approximately 5% of Cisco's workforce, was announced simultaneously with record quarterly revenue, and that simultaneity is the signal most holders are reading incorrectly. The consensus read is that the cuts are a cost efficiency measure layered onto a growth story, a margin improvement initiative that happens to coincide with strong earnings. The correct read is that the restructuring confirms the thesis shift precisely because of its timing. Companies cutting 5% of their workforce while reporting 12% revenue growth are not managing costs, they are relocating capital. Cisco said the restructuring is designed to redirect spending towards silicon, optics, security, and artificial intelligence, the four product categories generating the $9 billion hyperscaler order book. Up to $1 billion in pre-tax charges, with roughly $450 million landing in Q4 fiscal 2026 and the remainder in fiscal 2027, is the financial signature of a business model pivot, not a routine efficiency program. The charge schedule matters for holding period framing. The $450 million Q4 hit will compress reported earnings in the near term, which means the fiscal 2027 earnings base will be reached from a cost structure that has already absorbed the restructuring, not one that is still running legacy headcount. That creates a potential earnings inflection in fiscal 2027 that the current consensus may be underpricing, because analysts building models from the current run rate have to decide whether to treat the restructuring charges as one-time items or as the start of a permanently lower cost curve. The holding period horizon shift is precisely here. CSCO held for dividend income has a 1 to 2 year horizon, anchored to yield. CSCO held for AI infrastructure growth has a 2 to 4 year horizon, anchored to when the restructured cost base meets the accelerating revenue line. The trigger that would confirm the new horizon is Q1 fiscal 2027, the first quarter where CSCO reports against a fully restructured cost structure with the hyperscaler order book still intact. If revenue growth holds above 10% while the restructuring charges roll off, the multiple re-rating from income to growth is durable, and the current price to earnings of approximately 38 becomes the floor, not the ceiling. If hyperscaler capex softens before the cost reset completes, the stock carries both the revenue deceleration risk and the charge overhang simultaneously. That is the tail risk, and its threshold is whether the $9 billion order figure translates to recognized revenue in fiscal 2026 and early 2027 at the pace management has guided. The gross margin pressure HSB flagged, acknowledged by management but offset through pricing discipline and supply chain commitments, is the variable that connects those two scenarios, and it has not resolved.
CSCO's price to earnings of approximately 38 after the earnings gap is the central tension in any allocation decision, because that multiple sits between two incompatible reference frames. Against legacy networking peers and its own historical income stock valuation, 38 times earnings is expensive. The stock traded near a 17 to 18 times framework for most of the past decade, which is why HSBC's decision to raise its target multiple to 29 was itself a large move, and even that still trails the current market price. Against pure-play AI infrastructure names, where growth multiples routinely exceed 40 to 50 times forward earnings, CSCO at 38 times a rapidly accelerating earnings base looks like a relative discount, particularly given that its beta of 0.92 is lower than most high-multiple AI names. That beta figure is the risk structure element that changes the allocation decision. CSCO offers AI infrastructure exposure at a correlation below the broader market, which is unusual in a sector where most names move at a beta well above 1. The 52-week low of $62.30 versus the post-earnings high of $119.36 captures the full magnitude of the thesis transition in price terms. The stock has nearly doubled, and the institutional accumulation pace of roughly $2 of buying for every $1 of selling suggests that reweighting is still in progress, not complete. The checkoff anchor here is the $9 billion hyperscaler order figure disclosed on May 13th. If that figure converts to revenue on the guided timeline and fiscal 2027 earnings land above the restructured cost base, the current multiple compresses naturally and the growth thesis self-validates. If gross margin pressure, the one risk HSBC named explicitly and management did not fully neutralize, widens as Cisco competes on price to protect hyperscaler relationships, the earnings growth rate slows and the multiple gap against pure-play names reopens rather than closes. The $137 HSBC target and $132 BNP Paribas target are directionally aligned, but imply materially different margin assumptions, and neither firm has had a full post-restructuring quarter to test those assumptions against actual results. The lean here is that the thesis shift is genuine and durable. The $9 billion order book, the 15-year growth rate milestone, and the cost reset arriving together are not coincidental signals, but the gross margin trajectory in Q4 fiscal 2026 is the first hard data point that will either confirm or complicate the new framework, and that number has not yet been reported. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.